It was another record-setting day on Wall Street. The Dow, the S&P, and the NASDAQ, all, you might have guessed it, at all-time highs. Let me tell you how math works, Guy.
Go.
Every time the market goes up, if you're at an all-time high, that would be what?
A new high.
Correct. Our Bob Pisani joining us live from the New York Stock Exchange with more. Break it all down, make some sense, rein it in for us, Bob.
Nobody's getting past you, Brian. Stocks were back in record rally mode today. He's right. The Dow, S&P 500, NASDAQ all closing at new highs once again, though barely. Now, this marks the 30th record close of the year for the S&P 500. So the good news is new highs are expanding. And it isn't just a small group of super cap stocks, like Apple or Alphabet hitting new highs. We've had that problem before. Not now. There were over 200 new highs at the NYSE and over 300 at the NASDAQ. The New York Stock Exchange advanced decline line is at an historic high, meaning the market advance has been broad. That indicator, very bullish right now for the markets. Leading the charge once again were the banks. Bond yields rose early in the morning after strong housing and industrial production reports. They pushed the big banks, Bank of America, Citigroup, Goldman Sachs, to new 52-week highs, along with regionals like KeyCorp. And it's not just in the U.S. this rally, by the way. In Europe, the stock 600 closed at an historic high yesterday. Japan's Nikkei index is at a 52-week high, and believe it or not, it's close to breaking out to a 28-year high right now. Fueling the rally are what I call the four horsemen that have moved markets all year. First, the Fed is neutral. Second, the chances of a recession in the U.S. have diminished greatly. Third, there are the outlines, let's call it the outlines, of a truce on trade and tariffs. And finally, there have been some tentative signs that the global economy has been bottoming. But the global growth picture is a little bit more murky today, and that was a problem, especially after reports that Boeing could be looking to cut or halt production of that 787 MAX jet. And that's rippling through that global supply chain, hitting key suppliers like GE and Safran, which are building the engines, and Spirit AeroSystems, another major supplier. J.P. Morgan claims that Boeing's production could notably dent U.S. growth, possibly shaving off 0.5% from first quarter GDP. And Brian, that got a lot of play amongst the trading community today. Back to you.
Yeah, we're going to talk about it a little later on this show. Bob Pisani, thank you very much. All right. Just quickly, before we get to anything else, I want to, does anybody here own the Japanese market? By the way, by far the cheapest on every metric in the world, finally getting a little respect.
Yes. I am long. I mean, I'm long a whole bunch of international stocks. I've owned it for a long, long time, though. It's nice to see it. Still really, really cheap.
Yeah, it's amazing. It's gone from 8,000 to 24,000, yet it still trades at like one-time sales or something like that.
And they're starting to pay dividends. There's been a big structural kind of crafting of the corporate approach towards dividend and payouts, and they're about to do a big fiscal stimulus. So, if you want to ride this momentum, I do agree Japan's interesting.
Okay, so Wall Street has a new top market bull. Oppenheimer's John Stoltzfus releasing his 2020 year-end target today. He expects the S&P to hit 3,500, a nearly 10% increase from current levels. The question is this: how are we going to get there? Let's find out. John Stoltzfus, Oppenheimer's chief investment strategist, is here. John, welcome.
Here we are again.
Now, is this just like someone's got a 34.75? Let's prices right them, go to 3,500, or how
34.76?
How did you arrive at 3,500?
Every day we wake up and we say, should we turn bearish now? And then we look at the markets, we look at the math, we look at the economy, we look at what's happening geopolitically.
There's
the math?
Always trouble. What's the math that gets you there?
The math that gets me here is that we have seen remarkably good growth economically based on all the problems that we've had with the tariff war, all the problems that we've had with just the economic slowing that we passed through in the fourth quarter of last year and a good half of this year. But remarkably, when you look at the data, it wasn't recessionary. Companies have done remarkably well. The S&P 500, negative earnings growth the last 2 quarters, as I recall, but much better than expected. So negative growth, not as bad. And revenue growth is beginning to show. In the old days, if you'd had good earnings growth and revenue growth was soft, bears would say, oh, this is bad. It's got to be a bad thing. But now revenue growth is good. Earnings growth is a little weak, but not as weak as expected. I think going into this third quarter earnings season, they'll be jumping. They were looking for consensus was looking for 4% negative growth, and it came in at around 1 3/8.
Just quickly on that, before we get the guy, do we care about EPS anymore? And I say that because the amount of available stock has shrunk by so much. I think it's like 22% due to all the buybacks. you can game that EPS number. The revenue side sounds like a lot more of an optimistic story.
Well, and we're looking at not only at the revenue, but we also look at the earnings, because you have to have earnings. And the earnings, consider what saved earnings this year, we think in a lot of ways, is it was the second year of tax reform. So the comps were tough, but the reality was that most companies got to save more of what they earned than turn it over to the government. So that helped offset problems that companies may have had with the tariff war, that may have had due to slowing. They got to keep a little bit more jingle in the box. Related to buybacks, for years I haven't liked buybacks. But in this latest cycle, it's not a bad thing, because the biggest risk for most companies, we believe, around the world, for most companies, is overcapacity. It was proven in the chemical industry. I mean, just think, why did Dow and DuPont merge? They merged because China had developed their commodity industry to such an extent there was overcapacity. Overcapacity in aluminum, if you remember a few years ago, was created. Now, next thing, we'll move into overcapacity in tech. So if you're not a leading innovator, you really have to consider.
If you own a stock at $10, it goes to 15. The reasons why really don't matter, right? I mean, you're very happy about that, so I get that. But the Fed has expanded their balance sheet the fastest over the last 3 months than they have in the last decade. How much does that play into this? Because in my opinion, that's all this is.
I think it most certainly contributes significantly, particularly for traders, short-term opinion of the market and where the opportunity is. However, that said, I think what really enables the Fed to act the way it's acting and be able to be very sensitive to both weaknesses as well as strengths within the economy, I think is the very fact that you've got technology and globalization that are counterinflationary. They create abundance of within the labor pool is well informed, so it's hesitant to demand the kind of increase in wages it used to. With companies today, a relative upstart of a company can, in a short period of time, with access to affordable technology and easy access to technology, can become a competitive peer of a long-established company.
Yeah, and if you ignore home prices, car prices, healthcare, college costs, food prices, there's no inflation.
Yep. Well, if you look at college, prices, it's murder. There's the inefficiency, right? And medical prices.
Real estate.
Those are around the corner. When the iPhone starts helping you out with a lot of the basic medical stuff where you don't have to go into the office. That could be a big
John Stoltzfus, 3,500 price target right now. For now.
That's for now.
Because right now there's somebody watching Fast Money. It's like, I'm going to out Stoltzfus.
I think
and they're
that's going to happen, Brian. I'm expecting it. If not tomorrow, the next day.
And then you're going to go like this, and pretty soon it's, you know what it is? Wall Street strategist inflation. John, thank you.
Thanks.
3,500 guy, Dami. Buy a stock at 10, it goes to 15, you don't care.
You don't care the reasons why. No, you don't care. But you should understand the reasons why. You don't bury your head in the sand and say this is all because the world is such a great place. I don't think the world is such a great place. And John used sensitive. I'm not bringing the guests back, by the way. I would use reckless as the operative word to describe the Fed, but that's what makes markets. Listen, 3,500, you have to have $175 worth of earnings for the S&P 500 with a 20 multiple. In my world, that's a bit of a reach. Why are you looking at me with those eyes?
Just a big part of John's story is that EPS this year, coming into the year, was expected to be $175 in earnings this year. Where we're going to end up at 164. So you have this multiple expansion that's happened in the S&P 500. That's anticipating whatever growth we have in 2020.
Okay.